This is not a normal market signal. Credit spreads are widening while equity prices remain elevated. Investment grade spreads are moving above 150 basis points. High yield spreads are pushing past 400 basis points. That combination matters. It usually does not happen quietly, and it rarely reverses without consequences. This widening is a warning. It tells you stress is building under the surface. It tells you risk is being repriced before prices move. In the next 2 minutes, I'll show you why this matters for US traders. And let's slow this down and explain it simply. A credit spread is the extra yield investors demand to hold corporate debt instead of US treasuries. Treasuries are the risk-free benchmark. Corporate bonds carry default risk. The spread is the price of that risk. When spreads are tight, markets feel comfortable. Liquidity is easy, confidence is high, capital is cheap. When spreads widen, the opposite is happening. Investors want more compensation for risk. Lenders are pulling back. Financing conditions are tightening. This is the key part. Credit markets usually move before equity markets. Stocks are forward-looking, but credit is unforgiving. Bond investors care about cash flow, balance sheets, and survival. They react faster to stress. Right now, credit is flashing caution. Here's why this matters for US markets. Corporate America runs on debt. Buybacks are funded with debt. Mergers are funded with debt. Refinancing is constant. When spreads widen, borrowing costs rise even if the Fed does nothing. That hits earnings before stocks react. Margins get squeezed. Growth slows. This is where it gets important. Widening spreads change behavior. Banks lend less. Private credit tightens terms. High yield issuance slows. Risk assets lose support. Equity markets can ignore this for a while. They cannot ignore it forever. Historically, this pattern shows up before volatility. Look back at prior cycles. In 2007, credit spreads widened months before equities collapsed. In 2018, spreads widened before the Q4 sell-off. In early 2020, spreads blew out before stocks crashed. In 2022, credit weakened before the equity drawdown accelerated. Most people miss this. It's not about timing the top. It's about understanding risk is rising. Right now, spreads are widening despite solid headline data. That disconnect is important. It suggests markets are pricing future stress, not current comfort. If this spread surprised you, hit like so more traders can see this. Let's talk about why spreads are widening now. First, higher for longer rates. Treasury yields remain elevated. That raises the base cost of capital. Second, refinancing risk. A large portion of corporate debt rolls over in the next 2 years. Companies issued cheap debt in 2020 and 2021. That debt now matures into much higher rates. Third, slowing growth. Revenue growth is decelerating. Margins are under pressure. Defaults don't need a recession to rise. They just need tighter cash flow. Here's where it gets important. Credit spreads widen when uncertainty rises, not just when defaults happen. Markets price risk ahead of events. We are seeing that now. Investment grade spreads widening tells you even strong balance sheets are being repriced. High yield spreads widening tells you weaker companies are under pressure. This is not panic, it's reevaluation. Does this worry you? Type yes or no. Now let's talk about stress points. One major stress point is leveraged loans. Floating rate debt has reset higher. Interest expenses climbing fast. Companies that borrowed cheaply in 2021, 2022 are now paying significantly more. That squeezes cash flow, which means defaults become more likely even without a full recession. Another stress point is commercial real estate. Office exposure remains fragile. Many loans are maturing while property values are lower than they were pre-pandemic. Refinancing at higher rates is difficult, and lenders are becoming selective. Defaults in this sector could ripple into banks and credit funds, widening spreads even further. Another area to watch is private credit. Illiquidity hides risk, but it does not eliminate it. As defaults rise, pricing follows. Private debt investors may be forced to sell illiquid assets into a thin market, further amplifying spread widening. Most people miss this. Even if headline defaults are low, credit spreads widen ahead of actual defaults. They reflect uncertainty, not just realized losses. Here's where it gets important. Credit stress does not need a crash to matter. It slows markets gradually, it caps upside, pullbacks become sharper, volatility rises. Equities can still move higher while credit spreads widen, but the risk-reward changes. Rallies become shorter-lived. Corrections become more pronounced. For traders, this changes positioning. Risk-reward shifts. Momentum trades become more vulnerable. Leverage strategies face greater margin pressure. For investors, this changes expectations. Expected returns compress. Portfolio volatility rises. Diversification and liquidity management become more important than ever. Let's dig deeper into scenarios. Scenario 1, soft landing, slow grind. Spreads stay elevated but contained. Equities chop sideways. Volatility stays moderate but persistent. This is the caution without panic outcome. Scenario 2, growth disappointment. Earnings miss expectations. Spreads widen further. Equities reprice lower to match credit. This scenario pressures highly leveraged companies the most. Scenario 3, liquidity event, something breaks. A large default, a bank stress, or a credit fund redemption spike, spreads gap wider. Risk assets sell off quickly. Markets become volatile and correlations spike. This is where traders get hurt if positions are not managed carefully. Most people miss this. Credit spreads matter because they signal stress before equities react. They warn of tightening liquidity, rising risk premiums, and potential volatility spikes. Right now, that signal is active. That does not mean we are at a market crash. It means caution is required. Selectivity matters. Respect volatility. Here's the key part. Chasing upside becomes riskier when credit tightens. Position sizing matters more. Stops become more relevant. Cash becomes a strategic asset. Liquidity is risk management. This is why professional desks monitor credit spreads daily. They are one of the earliest indicators of stress. Ignoring them has historically been costly. Investment grade widening signals even strong companies are not immune. High yield widening signals riskier companies face pressure. The combination indicates system-wide repricing. If this spread surprised you, hit like so more traders can see this. Now let's connect this to implications for US markets. Borrowing costs rise, margins compress, and growth slows. Companies may pull back on buybacks and expansion. Equities lose underlying support. Market liquidity tightens. Volatility increases, even if prices don't immediately reflect it. The story is clear. Credit is flashing early warning signs. Traders and investors cannot afford to ignore it. Let's go deeper into scenarios. Scenario 1, the soft landing slow grind. Credit spreads remain elevated but contained. Equities chop sideways. Volatility stays moderate but persistent. Investors see muted returns, but the market avoids panic. Liquidity is tight but manageable. This is a cautious, disciplined outcome. Scenario 2, growth disappointment. Earnings start missing expectations. Spreads widen further. Equities begin repricing lower to match the higher cost of credit. Highly leveraged companies in sectors such as energy or real estate feel the pinch first. Traders who ignore credit signals may find themselves caught in sharper pullbacks. Scenario 3, liquidity event, something breaks. A large corporate default, a credit fund redemption spike, or banking stress. Spreads gap wider. Risk assets sell off quickly. Volatility spikes across equities, bonds, and credit simultaneously. Even the most diversified portfolios may feel pressure. This is where disciplined risk management becomes critical. Most people miss this. Credit spreads widen before markets react. They are forward-looking risk indicators, not lagging measures. Ignoring them can cost more than simply being cautious. Here's where it gets important. For US traders, the implications are clear. Position sizing is critical. Margin and leverage need constant monitoring. Cash and liquidity become strategic advantages. Diversification is no longer optional. It's protection. For long-term investors, this matters too. Portfolio volatility rises. Expected returns compress. Sector rotation may become necessary. Understanding the correlation between credit markets and equities is essential. This is the key part. Credit spreads are not noise. They are signals. They reflect rising risk premiums, tightening liquidity, and uncertainty that has yet to be priced into equities fully. Ignoring these signals can lead to surprises. Following them can help anticipate market stress before it arrives. Let's talk about the psychological aspect. Traders often underestimate credit signals because spreads widen without immediate headlines. The market feels stable superficially, but the undercurrents tell a different story. Patience and discipline here are more profitable than chasing short-term rallies. If this spread surprised you, hit like so more traders can see this. Now let's calmly wrap this up. Credit spreads are widening. This is not normal when markets are healthy. It reflects uncertainty. It reflects rising financing costs. It reflects tightening liquidity. Stocks may still hold for now, but the margin for error is shrinking. Volatility can increase without a full-blown crash. Risk assets may move in chop patterns. Upside is limited, and drawdowns can be sharper than expected. I track market stress signals like this regularly. Subscribe if you want early warnings before volatility. The key takeaway? Widening credit, spreads matter now. They warn before equities react. They reflect system-wide repricing of risk. Discipline, liquidity, and selective positioning are more important than ever. Do you think this situation improves or gets worse? Comment, improves or worse? Stay flexible. Stay aware. Respect what credit spreads are telling you. Markets are complex, but credit spreads give you clarity. They are an early signal, not a headline. They provide a roadmap to navigate volatility and risk. Remember, ignoring credit signals can be costly. Paying attention allows traders and investors to adapt. Prepare, adjust, and position wisely. That concludes this analysis on why widening credit spreads matter now. The message is simple. Markets are signaling stress.